Welcome back to my Accounting 101 series. Today we're going to talk about an income statement, what goes into it, what types of transactions are captured on an income statement, the various names of an income statement, and other important facts. Hi, my name is Chris Passmore and I'm your social media CPA. So an income statement, probably the most important financial statement for a business or a company owner. It's also known as the statement of operations, what us accountants call an income statement when you're actually losing money, or a P&L or a profit and loss statement. So a income statement represents the items of sales and expenses for a period of time for a company, often a year or a calendar year from January 1st to December 31st. So let's talk about the items that go into an income statement, and we'll work our way generally from top to bottom. If you think about it in the sense of a table, you start at the top and you work all your way down to get to the bottom, which is normally your net income amount. So at the very top, the very first item normally presented on a income statement is your revenue or sales. These are the proceeds from either the sale of products or services that you provide to your customers. It can also include other amounts like discounts or other concessions that you've given to your customers that nets against that sales amount. But in general, it represents the amount that you've sold your goods or service to your customers. Following sales is cost of goods sold. This is the general cost of the item that you delivered to your customer. If that's a product, that could be the cost of the goods, the inventory, the expenses that were put into the item that made it ready for sale if you had to invest labor or other items. Or it could be the cost of the services. If you provide a professional service, like myself as an accountant, my cost of services would be my payroll expense. And that would capture everything specifically related to the service or goods provided to customers or clients. The next item is a subtotal of your sales and your cost of sales, and it's an amount called gross profit. This amount is intended to represent the amount of profit you make from the core sale of a product or good before any other general operating expenses like rent. So this is meant to represent truly how much you make when you sell a product and what's your margin there. Gross profit is a dollar amount, and you can also use gross profit margin, which is a percentage which takes gross profit dollars divided by your sales. So as an example, if you sold a product for $100, the cost of that product was $80 and you had gross profit of $20, you would also have a 20% gross margin. Normally you don't present the gross margin percentage on your income statement, but you do use that gross profit dollar to calculate that amount. So working our way down the income statement further, following gross profit is normally your operating expenses, also known as general and administrative expenses. This is a pretty broad category of expenses, and it can include a number of items, but you'll commonly see things in there like rent, depreciation, administrative payroll expense, property taxes, things of that nature. And those all add up to your total operating expenses on your income statement. The next item on the P&L is a deduction of the operating expenses from the gross profit to represent income from operations. This is a subtotal to show how much money the company is making before other items such as tax and interest expense, and that's your income from operations. So moving further down the line, after income from operations, which is a subtotal, this is where you have other income and expenses and income taxes. So you would have your federal and state income taxes. You would have other items that are not related to the operations of the business, such as interest expense, interest income in case you have any excess cash invested in a money market account or some form of interest-bearing account, or other losses. Let's say there is a casualty loss, a company vehicle that was used was in an accident and there was a loss related to an accident for that vehicle would be captured there. The reason why this is below income from operations, because it's not really related to running the business. It's a part of the business because you had a company vehicle, but an accident and the cost of getting the accident dealt with is not really a normal recurring item. And so that's why we normally put this at the bottom of the income statement, so any reader will know that this is often unrelated to the business or non-recurring. And then the final amount on the income statement is your net income or loss. That is the income from operations less your other income and expense and taxes. And that's the total. That shows what your net profit or net loss is for that period of time. Obviously, if it's a positive amount, you are making money. And if it's a negative amount, you are losing money. So that's a summary of what makes up an income statement. Again, the most important financial statement in running a business, in my opinion. Well, for more information on other accounting topics, you can always visit me on my website. That's socialmediacpa.com, and follow and like for more information and tips coming soon.